Welcome, everyone. Today's discussion, which has been arranged by the experts at My Tax Accountant, is all about unlocking some significant tax relief that, honestly, you might not even know you're owed. If you're a higher earner with a pension, this is definitely for you. Let's kick things off with a massive number, £800 million. That's the estimated amount of pension tax relief that goes completely unclaimed by higher-rate taxpayers right here in the UK. Every single year. That's a staggering amount of money just being left on the table. And that leads us to the most important question of all, doesn't it? Is some of this money yours? Are you one of the thousands of people who are essentially giving your hard-earned cash to HMRC for free? Stick with me for the next few minutes, and we're going to find out.
So, here's our game plan. We'll look at your unclaimed cash, break down how the tax relief actually works, and figure out who needs to claim it manually. Then we'll get into the nitty-gritty of claiming it, cover some advanced rules and common mistakes, and finish up with deadlines and where to get expert help. Okay, let's dive in. First things first, let's really get our heads around why this is such a huge deal for so many people and why it could be for you too.
You know, this chart really tells the story. A full 20% of people who are eligible, that's 1 in 5, don't even realize they have to make a claim. And then you've got another 15% who know they should, but just haven't. That's a huge number of people missing out on their own money.
And that's the bottom line. It's as simple as that. This isn't some complex, shady loophole. This is tax relief you are legally entitled to. The only catch is, the system is set up in a way that means you have to actively put your hand up and ask for it.
So why do you have to claim it? Well, it all comes down to the fact that there are two totally different systems for handling pension tax relief.
With a net pay pension, your contributions are taken before you get taxed, so you get your full relief automatically. No action needed, nice and simple. But with relief at source schemes, which are really common for personal pensions, you only get the basic 20% relief added for you. If you're a higher rate taxpayer, claiming that extra relief is on you.
Okay, to claim this correctly, you have to start thinking in terms of the gross contribution. This is vital. It's not just the money that left your bank account. It's that amount plus the 20% tax relief the government already added. So if you pay in £8,000, your gross contribution is actually £10,000. That's the figure HMRC cares about.
All right, let's make this real. Theory is one thing, but a real-life example makes it click. So let's meet Alex, a freelance IT consultant in London who's on a good salary and is being smart by saving for the future.
So, Alex pays £8,000 into their pension. The provider automatically adds £2,000 in basic relief. This makes the gross contribution £10,000. But because Alex is a 40% taxpayer, they are owed another 20% on that gross amount. That's an extra £2,000 that Alex has to claim back manually. If Alex does nothing, that £2,000 is just gone.
Now let's look at the next step. You've seen how it all works, but how do you know if you're one of the people who absolutely needs to take action?
Think of this as your personal checklist. If you're a higher rate taxpayer, that means your annual income is over £50,271. Or if you're self-employed, or you have a private pension like a SIP, then you should be paying very close attention. This is your cue to take action.
And here's a quick pro tip for you, and it's a brilliant extra benefit. Making these pension contributions reduces what HMRC calls your adjusted net income. Now, why does that matter? Well, it can actually help you reclaim your personal tax-free allowance if you earn over £100,000. And it can also help you avoid the high-income child benefit charge. It's a real win-win.
Okay, so you figured out you need to make a claim. Now for the practical part. Here is your map to that treasure, the self-assessment tax return.
Following these 4 steps turns what seems like a bit of a headache into a simple checklist. Get registered, grab your paperwork, find the right box on the form, and, most importantly, enter the right number. Step 4 is absolutely critical.
Let me say that again, because this is the single most common mistake people make. You must enter the total gross amount. That's your contribution plus the basic relief already added. For Alex, that's £10,000, not the £8,000 that they saw leave their bank account.
So, once you've submitted your claim, how do you get your money back? Well, it usually happens in one of 3 ways. They might adjust your tax code, which means you pay less tax each month. Or you could get a nice straightforward refund paid into your bank. Or they'll simply deduct it from your overall tax bill for the year.
That's not all. Here's where most people go wrong.
especially if their situation is a bit more complex. Let's cover some of these advanced scenarios.
Generally speaking, you can contribute up to £60,000 a year into your pension and get tax relief on it. That's your annual allowance. But what if you want to put in more?
This is where the carry forward rule is fantastic. It allows you to use any of your unused annual allowance from the past 3 tax years. It's incredibly useful if you want to make a larger one-off contribution without getting an unexpected tax bill.
Now, stay with me on this next point because it might just surprise you, especially if you're a high earner. Your personal allowance might be a lot lower than you think.
This is the tapered annual allowance. If your adjusted income goes over £260,000, your tax-free pension allowance actually starts to shrink. For every £2 you earn over that threshold, your allowance reduces by £1, and it can drop all the way down to a minimum of just £10,000. It's a major trap for high earners.
So, to quickly recap the most common mistakes: putting in the net amount instead of the gross, forgetting you can backdate claims for up to 4 years, and completely forgetting to include contributions you've made to a separate private pension. Just double-check your return to make sure you haven't fallen into one of these traps. Finally, let's cover the all-important deadlines and where to turn if you need a guide for this treasure hunt.
Okay, here are the key dates for your diary. The big one is the online filing deadline of the 31st of January. Miss that, and you'll get an automatic £100 penalty. So please don't leave it to the last minute.
And please, remember that 4-year rule. If you've just had that aha moment and realized you've missed out, it is not too late to claim for previous years. That could mean a very significant refund is waiting for you.
Getting this right can save you thousands, but as we've seen, getting it wrong can be costly. If you're dealing with tapered allowances, carry-forward rules, or you just want that peace of mind, professional help is absolutely invaluable.
The team at My Tax Accountant specialize in helping taxpayers with exactly these kinds of claims. If you want expert advice on your pension tax relief or any other tax issues, just contact them. You can call them on +44 08 570 8531 or email them at info@mytaxaccountant.co.uk.
So, as a final thought, what could an extra few £1,000s a year mean for you? It's your money after all. Make sure you claim it.
We really hope this has been incredibly helpful. For more clear, actionable financial guides just like this one, please make sure you subscribe to the My Tax Accountant YouTube channel. Thank you so much for watching.